Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with me. It's Friday. Happy Friday, TGIF. How are you doing?
Amen. It's Friday. As you know, it's been a crazy week.
It has been a crazy week. So, we're just coming off a jobs report. We're going to talk about that. Obviously,
Yep.
We had so much data this week as far as economic data went, and between now and then, or the last time we met, I should say, the last time we met, which was last Friday, we had a ratings downgrade. And what do you make of that? First and foremost, let's start with that.
Well, first of all, it's a longer term call. So in terms of its immediacy, I think it's, on the back burner. The main point is they talked about dysfunctionality in Washington. So
I thought you were going to say dysfunctionality in the markets. I mean, we got that too.
Markets are always efficient, Blake. They're always anticipating the future with 2020 or forward sight. But no, to me, the main message is dysfunctionality. Because if anybody spends any time looking at the longer term debt numbers, come on, it's like, all right, you either believe that they will not ever matter, or you think they at some point in time must. And so dysfunctionality to me was I took away the main message. And then what did we get a response out of the Republicans and Democrats? More dysfunctionality, in terms of each party blaming the other. And again, whether you do it through tax cuts or you do it through spending, a dollar debt's supposed to get repaid. So to me, the reaction that we saw was almost like verification that what Fitch said in terms of functionality is alive and well.
Well, let me ask you this: since you've over the years, one of your I guess many job titles over the years, you talk to a lot of institutional clients, bigger clients, risk managers, that type of thing. How does this move by Fitch affect portfolios? Like some of them that have certain mandates that they have to keep AAA paper in their portfolio. Now that they don't have it, they have to sell their treasuries. Is that even an issue? Do you think?
I don't think so, quite honestly. If you're a pension fund, an insurance company, you're going to grab yield no matter what causes that yield to tick higher. So, and again, what we saw pretty much across the board was, it's not that big a deal. Now, this is one of those times where in the near term, I think what the Bank of Japan did last week is much more important and impactful in terms of what's going to happen to Treasury yields in coming days and weeks. And we talked about that last week. And, my conclusion was that given if you're an insurance company in Japan, and now the BOJ says, we're going to let the 10-year go up to 1%, you might want to consider being a seller, but you're not going to do aggressive buying at 0.6. I think most will wait until you get to 0.8, 0.9. And as Japanese yields tick higher, to me, that puts upward pressure on global government bond yields. And so that was more important than the Fitch stuff. And in my opinion, we saw that happen because the BOJ, the 10-year in Japan has gone from under 50 basis points up towards around 65. And lo and behold, we saw 3 down days, very significant down days. And on TLT, 3 gap days. Volume was double the average, daily average. So there was a huge input. Now, to me, did the Fitch news add to that? Absolutely. But I believe in terms of the here and now, the Bank of Japan's decision last week is just more important in terms of what's happening with pricing now.
So, I mean, Japan owns 15% of U.S. debt.
They're the biggest foreign holder. I think it's around 1.2 trillion.
Yeah, now they own 14%. You're saying? Just kidding. Just kidding. No. I'm joking.
Well, yeah. I mean, some of the risk people are like, oh my goodness, maybe if you're a Japan investor and you think your yields are going to go up to 1%, might you be less aggressive in upcoming auctions? In addition, the Treasury came out and said, we're going to really flood the market with more treasuries because the deficit is worse than we expected. Tax revenues are down, spending is up. It was a little bit like a perfect storm coming together. Plus this narrative that there isn't going to be a recession. So, and then last but not least, news came out yesterday that Ackman, big hedge fund guy, has a big short position as well. So to me, it was like everything coming together to create a selling squall. And, the rubber band got stretched. Japanese bond yields actually ticked down slightly today. We got a jobs number that, wasn't a blowout, so gee whiz. The odds of the Fed raising the funds rate in September went down to, even lower level than it was.
Yeah.
So to me, this is, we're getting a technical rebound in markets. The dollar sold off. The gold's getting a little bit of a tick up. Bond yields coming down. The market's stock market's getting a bounce. So to me, the true test will come next week to see, okay, now the dust settles a little bit. What follow through do we see?
Well, I can't wait to see your technical setups and what you brought here today for the Forex Analytics subscribers. I'm so sorry. That's my company. But if you want to be in Forex Analytics, hey, be my guest.
Yes.
Just kidding. I meant Traders Summit. Oh my gosh.
Now.
It's a Friday slip. I just got to say that. But no, I can't wait for what you have in store for the Traders Summit community today. With that being said, if you like what Jim does here every week and you like that Blake can't speak correctly on Friday, give this video a big thumbs up, subscribe to the channel. Also, jump in the comments, and if you have anything to tell Jim about Japanese foreign bondholders and how they feel right now, let him know. I think he'd love to hear it. So Jim, let's start off with your first chart that you brought us, and you bring lending standards. Now, this has been a big debate amongst my community, which I just mentioned here a second ago, but a big conversation I've had, with, in regards to, we have inflation data coming up, but you got next week CPI, which is a big deal. But you got lending standards that are very, very tight, but you've got inflationary pressures that are still very strong. And I mean, how is this? I mean, with lending standards tightening, inflation continuing to stay relatively strong, and I can't wait to hear your comments regarding inflation next week. But with all this put together, what does it mean for our economy, and what do we do here with this chart?
Well, we've been talking about this for months because lending standards really ticked up late last year. This is the report that came out on Monday, so this is the most recent update. Powell knew these numbers because in his press conference, he referenced, well, they're going to show what you would expect them to show. And so lending standards went from 46% of the banks tightening to just over 50.8%.
Yeah.
Spreads increased, where 67% of the banks have increased the spread on money. So you have two things happening. The Fed has raised, obviously, the funds rate by more than 500 basis points. And on top of that, loans to small and medium-sized businesses, the banks are adding another surcharge in effect. So as we've talked, there is a lag. If somebody has a loan that they took out last September, October, okay, yeah, it was a little higher because the Fed had raised the funds rate about 200 basis points, anywhere from 150 to 200 basis points. And so they got it paid up. Yeah, but the next 300 basis points of Fed tightening is what, when their loan comes due in September, they're going to be faced with. Plus, their credit line, maybe it was a $500,000 credit line, maybe the bank cuts that back as well. But my only point is that the lag effect, it just takes time for this to really have an impact. So companies have been moving to lower costs. We've seen hours worked, overtime hours be shaved. So at some point in time, if economic growth slows, the pressure will mount for them to cut costs, and the most critical cost is labor costs. And I still think between now and year end, lending standards and some of the other long leading recession indicators are going to bite more and more. And we're going to see unemployment claims start to tick up in a meaningful way. It hasn't happened yet, really. We had a little bit of an uptick. Now they've kind of receded a little bit. So we'll see. To me, it's a negative for the economy. But I think, as we've talked, a year ago, everybody was sure we were in a recession. We had 2 quarters in a row of negative GDP. And then they thought, okay, we're going to have it early this year. And you and I talked. It was like, nope, they're wrong to think that. And we gave all the reasons why. And my message has been, it's the second half of this year. Some slowing showing in the third quarter and then more pronounced slowing in the fourth quarter. So in my opinion, Blake, psychologically, the markets have gone from, oh, I'm so worried about a recession and low positioning in stocks to, oh, now I don't have to worry about a recession. And people are, more fully invested. Huge increase in hedge fund short covering has also played a role over the last 6 to 8 weeks. So a lot of things have come together to help the markets get to where they are. The foundation is, we don't think there's a recession coming, but the lending standards kind of say that's premature to come to that conclusion.
And I'm going to point out, and I just drew it on the chart. It might be hard for you guys and gals to see it at home, so make sure you're looking at your screen at this moment to see the image that Jim brought. The very, very dark. Well, I mean, it's very light, but you can see the shaded area. Those are the recessions, right? And this is the GFC. This is COVID. Right here, and this is the .com, right? And before that, in the early 90s, those are the recessions. And you can see where lending standards, now I would say that the GFC was kind of an anomaly, right? Because lending got obviously out of control when you have, people that shouldn't own 3 homes, they own 3 homes, and then COVID was a little crazy because it was a lockdown, and you can get why, standards just jump like that. This would be more of a normal economic cycle that we're in right now, I guess, semi-quasi, right? Post lockdown. And it's very close to levels that we saw during the .com bubble, which put us in a very long, prolonged recession. And then back in the early 90s too. So, which I happened to be in the military at that time, and I think I was overseas, so I don't quite remember. But I think you just got to realize the significance of what Jim is outlining here, that we are at levels that really tend to trigger a recessionary.
And response. It happens before the recession kicks in. And then obviously, as the economy slows, goes into recession, banks increase lending standards even more. We've already seen a decided pickup in delinquencies for credit card payments, auto loan payments. The banks in February were rejecting 9% of all auto loan applications. Now it's up to 14%. So the cracks are there. The other thing I will point out, in March of 2007, I was writing about the increase in lending standards that had taken place in the first part of 2007, and then basically said, hey, we're headed towards a recession. And so that was one of the tip-offs for me that, hey, things were going to get weaker. And as they do, banks tighten even more. So again, I think the hook here has been so many people jumped on the recession bandwagon, Blake, incorrectly. Last year, expecting it earlier this year. And it's almost like, you know what, I'm not going to pay attention to the yield curve. Lending standards, a lot of people don't pay attention to anyway. Leading economic indicators, hey, that's old news. They've been negative for 15 months, and everyone said they were going to cause a recession. It hasn't happened. So I think there's just this, you like to do this, you cover your ears. I'm not listening to that recession talk anymore. And again, the irony is, I think the next 3 to 6 months is where there should be more concern. Now, as I've tried to frame this in the last couple of letters, we've got this window. Is recession data going to show up sooner or later? In my mind, it's not a question of if, it's only when. So there's a possibility, like in equities, we could have a pullback, and I think a 5 to 7% pullback is already begun. And then if the economy still, like the jobs report today, still shows it's doing okay, you can have another march to a higher high in the S&P because the narrative, we don't have to worry about a recession, encourages buying the dip and so forth. So to me, the next few months are going to be a little tricky. And maybe I'm wrong. Maybe there won't be a market slowdown / recession. I just think historic precedents kind of says, hey, you're going to bet against things that have been the most reliable recession indicators the last 50, 60 years. My answer is no. One thing I'll point out, remember Powell said soft landing, and he cited 1965, 84, and 95. Well, look at in the middle between 91 and 2000. You can see lending standards didn't go up. That's why you had a soft landing in 1965. I have another chart that shows the same thing happened in 84 and 65. Yes, the Fed raised the funds rate from 3 to 6% from 1994 to 95. But lending standards never tightened. So that to me is
or marginally.
Yes. Yeah. I mean, that's to me the difference in terms of the probability of avoiding a recession and getting a soft landing is lending standards, because the banks are choking off credit and also increasing the cost of credit to small and medium-sized businesses that really depend on bank lending more than any other source.
All right. Well, Jim, we spent a lot of time on lending standards. I think it's very important for people to understand. Next chart, you were talking about how important what happened with the BOJ this year or this week was.
So you can see going back, a bunch of months, the BOJ had their ceiling at 50 basis points. They increased it from 0.2 to 50 basis points last December. What happened? The 10-year Japanese bond yield went right up to 50 basis points. That's when the BOJ came in and said, nope, we're buying here. All right. Now we've seen is a technical breakout. Obviously, we know the reason why. But my point is, I can't imagine that yields aren't going to go up to press 90 basis points to 100, just like they pressed from 0.2 to 0.5 in the first few months of this year. And so as Japanese bond yields go up, I think that just raises the pressure on Treasury yields and government bond yields around the globe. So to me, this is why we saw this huge spike in Treasury yields between last Thursday and yesterday. I mean, we're talking about gigantic moves of 30 basis points in 4 days.
Yeah.
That's like, well, I saw Jason Furman. He basically said it was a 2.5 sigma event, which like, no, I guess, mathematically that's a big deal. So.
All right. Well, then the next chart you bring up is the 10-year yield gap versus the S&P. So
here's the thing is all of last year, what we saw is as Treasury yields went up, the stock market went down. Then when Treasury yields topped out in October, the stock market bottomed out in October. And as Treasury yields worked their way down, the S&P worked its way up. And then suddenly, as we got into May and especially June and July, what we saw is this bifurcation. The S&P just kept going up despite Treasury yields working their way down. Well, what caused that? In June, as you might remember, artificial intelligence became this manic kind of rage that really helped anybody who associated, and it was pretty much mega cap stocks, lifting the S&P. Well, since early July, because the last jobs number was pretty decent, this consensus that, we don't have to worry about a recession has enabled the S&P on the idea that, earnings are troughing in the second quarter, they're headed up from here. So my point is this gap between Treasury yields and the S&P is very, very wide. Obviously, if Treasury yields tick higher, you just have to wonder, when is the pressure on mega cap stocks going to pick up? So we got Amazon, surprised a lot of people. Stocks up 10, 11%. Some of the tech stocks that got hit are getting bounced. But the bigger point I would make is that Treasury yields are more important than Amazon's earnings. From a speculative sentiment standpoint and zero dated options, oh my God, let's jump on the bandwagon today. But I think this is an important chart. And if I'm right, that Treasury yields will mirror the increase in Japanese yields by rising further. I just think that increases the pressure on those mega cap stocks valuation wise, and that leads to a pullback. Again, I think 5 to 7%. That's a garden variety pullback. The nature of that pullback in terms of if it's 5 waves versus 3 waves will be instructive in terms of what comes next. But we don't know the answer to that until it actually unfolds. So,
all right, Jim. Well, we're waiting to see how that unfolds. Next week we got CPI.
yep.
So I gotta say here, CPI has come down pretty far, pretty fast. But can it continue? Or I got to ask that question. Can it continue?
No, on the headline, no. The answer is very simply, again, if you look at, it's a 12-month rate of change. So they took out whatever went up in May of 22, it was 97 basis points. In June, 1.32%. So May and June was subtracting, 2.3% off of CPI. Well, if you only add 0.2 or 0.3 of current inflation, boy, you're going to bring those numbers down significantly, which is exactly what happened. I mean, last October, I was talking about this with you, that we would see the CPI potentially by June come down below 4. And it was all based on this mathematics. So what happens in July? So when we get the CPI for July next, I think Tuesday, is the 10th. Hey, the takeaway value is 0 effectively. So whatever the month over month CPI is for the month of July, the headline number is going to move up. I think you've got energy, gasoline prices are up. Now countering that will be probably used car prices coming down some more, shelter coming down a little bit. So I just think that there's a good chance that the unbelievably good news of the CPI almost collapsing the last 2-3 months, and you get an uptick. Ooh, wait a second. Maybe the Fed won't be so happy with that. Now, the core CPI has the potential, because you're taking away 0.3, has the potential to downtick a little bit more, especially as when we get into August and September, because you see the takeaway values then is 0.6, 0.6. So I just think you have this 1 to 2 month for July and August, where the headline CPI has the potential of ticking up a little bit. The core maybe ticks down some, but more people pay attention to the headline than they do some of the other numbers. The Fed pays more attention to the core PCE. But anyway, in terms of headlines, I just imagine that, whoa,
it might be a little scary, right?
Well, just like, oh, wait, maybe it's not going to be so easy. Maybe the battle isn't completely won yet, coupled with then people saying, well, in that employment report, wage growth ticked up.
Yeah, sure did.
That maybe this battle is going to be a little bit more extended. And so I just think that the drop in CPI since last October has been one of the real big tailwinds for the equity market, because it also led to a drop in Treasury yields. So again, this is what's coming.
All right. Well, the next chart you have here is Treasuries. So let's talk about.
Yeah, both 10-year on the left, 30-year on the right.
Okay.
The point I've been making the last number of weeks is the red trend line on both of the 10 and 30-year. And this happened in early July. They broke out above that. Well, that's when the idea that, hey, we don't have to worry about a recession really seemed to coalesce. And then we got a great CPI report. Yields dropped back down to that red trend line. Weren't able to get back below. And then we've seen this big rebound, especially over the last week. As you can see, the 10-year, when we were talking last week, it was 397. It ticked up to 420. The 30-year was even bigger. I think it went from I can't even read this print here. Anyway, it went up a lot. So the black trend line shows that, yesterday the 10-year gapped above it, and now it's coming back down. Today, the last I saw was, I think, around 407, 408.
Yeah.
So it's trying to get back below. The 30-year is still comfortably above that black trend line. So to me, it just comes down to early next week, if Japanese yields continue to tick higher, is this relationship going to continue to lift the 10-year back above that black trend line? To me, the path, just based on the chart, appears to be up. But you just had this gigantic move in a very short period of time. And, if you're an insurance company, a pension fund, hey, 420 on a 10-year relative to what we've seen over the last 4 years, that looks kind of attractive.
Right.
So anyway, to me, this was the chart analysis that said last week when we spoke, I said the path is up. I had no idea what was going to happen with Fitch or anything else. Again, I think the Bank of Japan news is more important. So I would urge people to, stay on top of what the 10-year Japanese yield is doing, because I think that's an important input at this point in time in terms of how Treasury yields are going to trade.
Well, you brought up a chart that you don't normally bring here. You brought the Russell 2000. Why did you do that?
I did that because, again, we just talked about with the Treasury yields breaking out in July.
Yeah.
Well, look at what the Russell did. It broke out above that blue trend line in early July. So as yields were going up because, hey, wait a second, we don't have to worry about a recession. Oh boy, it's time to buy small caps. They've been so underperforming relative to the S&P. So to me, one of the things in terms of, okay, are we going to get a 5 to 7% correction? Well, it's not going to happen unless the Russell closes back below that blue upward sloping trend line. Now, I think the odds are it will do that, but it's always one step at a time. And that to me means that the Russell might be more important in the very near term than the S&P 500.
Not only do you have like a little false breakout, you have a little bit of a double top here. So yeah, a lot of big resistance in the Russell.
There's a lot of markets that are just kind of at the pivot point of something, and which obviously makes the level of certainty, at least for me, be much lower than maybe normal. Because I can, again, if the economy continues to hold up, that obviously is not going to be supportive of Treasury yields coming down a whole lot, but it'll help maybe the equity market a little bit. So if we do get that 5 to 7% pullback, Blake, one of the things I'm going to be looking at is, okay, the mega cap stocks would likely be the weaker group in that environment. What happens with cyclical stocks? Do they hold up better?
Yeah. Do we continue to see rotation, or do you see an exodus?
Yes.
And the exodus would come here, right?
Yes. And also, at the point in time, if and when we really see definitive data showing things are slowing, cyclical stocks are going to be vulnerable in that environment. So again, the timing of when that data shows up is really, I think, really critical. All right, dollar, the low at 99.57 is key because we may have finished something from the high at 114 down to there.
Yep.
Had a nice little bounce.
These are equal leg moves, by the way. Those two.
Yep. And it's pulling back on the jobs number. Why? Because that lowered the probability that the Fed would move in September. But overall,
even with the strong labor market data. I mean average hourly earnings.
Again, that doesn't get as much. That doesn't get the headline as much as, hey, job growth slowed to this number. And for the 5th or 6th month in a row, prior months numbers were downgraded a little bit. I think it was like 25,000 from
not much, but
last month's number. So again, people are looking at inflation's coming down, as we've seen on the CPI, and that's why I said earlier, you might get people starting to pay attention to the wage growth number if the CPI ticks up. Oh, wait a second, remember in that report? So to me, again, the dollar, I think there's a big short position relative to the last 5-6 years. Whenever we had this big of a short position, there's been a big rally. I mean, in 2021, when the dollar was hovering around 89, you had a big short position. Now, again, you were on the cusp of the Fed being aggressive in terms of monetary policy. So I don't think we can equate magnitude of rallies because you're not going to obviously duplicate that. But to me, it suggests a rally towards 104. Then if you get above 104, that's when short covering could really, power the next move up towards the high back in March at 105.88.
Okay. Well, so, the asset class that probably be punished would be gold. So what do you see with gold? Because I personally, I thought gold held, and this is very intraday stuff, guys. So I'm just going to tell you, I was monitoring this little channel. We're kind of at the bottom of the channel right now. I mean, that held today following jobs, but I mean, bigger picture, this is what you're looking at, Jim. How do you feel about gold here?
I still think the odds favor that gold's going to drop below that 1894 number. In other words, you had a wave A down,
Yeah.
B wave rally, then we're going to get a C wave to complete wave 2. So again,
C waves are kind of big, aren't they? Can they be?
They can be equal, or obviously they can extend beyond the length. The 50% retracement of the move up from last September's low to the high in May is 1837. The first leg down was 160 some dollars from the May high to the low we saw in June. That gets you, I think, around 1820-ish or something. So again, if the dollar follows through to the upside and Treasury yields are a component of that, they work their way up as well. Well, then that makes it logical that, okay, gold is going to be weaker in that environment. So that's why I said earlier, man, so many markets are kind of up in the air.
Yeah.
But just looking at the pattern, I think gold is more likely to drop below 1894. Once this pullback is complete, I think gold begins a fairly significant rally. So, I mean, above, like, to new all-time highs. So, it's kind of like, all right, trying to thread the needle here a little bit in terms of one more leg of weakness, creating that buying opportunity.
Makes sense. All right. Well, Jim, so as far as next week goes, I mean, CPI is a big deal. You think the numbers might come in a little hotter than market expects? And if that happens, I just, broad markets wise, stocks, S&P, Russell, Dow, NASDAQ. I mean, you got Amazon that's up today. You got Apple that just tested the breakout point today. It came down aggressively, but
yes,
holding. Do you think the broad markets act negatively if we have a stronger inflation print?
If Treasury yields tick higher in response to that number, yes. And again, that's what I'm saying. Watch the 10-year yield in Japan, because I think that is really important at this point in time. So just looking at the probability that the yield in Japan is going to go from 65 basis points up towards 90 basis points, maybe all the way up to 1%. I just think that is not supportive of Treasury yields coming down at a time when we're going to see a lot more supply coming in. So until we see definitive data showing that, hey, that slowdown is starting to arrive, I think we have to respect that rates will be supportive of the dollar. And to the extent that happens, that one chart showing the gap between Treasury yields and the S&P, that widens. I just think at some point in time, the mega cap stocks are going to be vulnerable to a pullback. And the cyclical stocks will probably hold up better relative to them. And then their point of weakness will only arrive when we see data showing that, yes, indeed, the economy is slowing more. So the timing of that slowdown is critical to exactly how much more yields can push higher. I think over the next handful of weeks and a little shove from the CPI, we could see things get weaker going into the end of this month, and then we'll see what the next job numbers is and so forth.
Jim, every trading day, and I've told my my traders that we discuss every day, every day for me, it's like somebody throws a jigsaw puzzle at me and I've got all these pieces and I got to put it all together. I have to say, you're really good at putting puzzles together. Sometimes I feel that some traders have that corner piece and they're trying to fit it in, or they think it's a corner piece, but it's actually on the edge. So I think you're doing a great job taking that puzzle piece and putting it back in the corner for him. So, Jim, I want to thank you.
Try,
Yeah. No, I say every week you put it all together for the Trader Summit community. And I want to urge everybody to check out Macro Tides, and you do give them a discount, right? If they're coming from Trader Summit.
20%, baby.
All right. Well, the email is jimwelshmacro@gmail.com. So make sure you reach out to Jim. Jim, I thank you every week for putting it all together and helping us with the puzzle pieces every week.
My pleasure, Blake. And we've got another fun-packed week coming up.
All right. We'll get some rest over this weekend, and good luck for CPI.
You too. All right, buddy.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.